Please remember that futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I author in my weekly written reports. Prices shown on charts and quote bars are in real time and take into account all known activity up to this point in time. If you'd like to read more of this disclaimer, simply hit the pause key on your computer screen. Welcome traders, I'm Boyd Baker, and thanks for tuning in to the fourth of a series of options tutorials. Today we're going to talk about what determines the price of your option. Now there's two key values that we need to talk about here today. That's intrinsic value and time value. When you add those up, that's going to equal the option premium. That's going to be the cost of the option to you when you're a buyer, that's a defined risk, or when you're an option writer or seller, that's the amount of premium that you're going to collect. The intrinsic value is really just the amount of value that the option is in the money by. We discussed that in previous segments. The time value or extrinsic value, that's the amount that the option is valued up and over the intrinsic value. Now, while that might sound confusing to you, I think we can explain this a little bit better with a gold chart. This is the same gold chart that we've talked about. Gold prices have moved down a little bit lower, and they're trading right now at $12.09. We talked about out-of-the-money options, and they would be like a $12.50 call. Right here, if the market is trading at $12.09, the 1,200 calls are in the money by $9. So the 1,200 call has $9 of intrinsic value. That's what it's in the money by. Now, if you're buying a fair amount of time, let's say you're buying 6 to 8 months of time, of course that option is going to have more value than just $900. It may be trading at $1,900. So that value of the option is going to have $900 of intrinsic value and $1,000 of time value. Now there's lots of factors that impact option prices, and most importantly, really it's the amount of time that you buy. If you're buying an option that has only 2 or 3 months of time, it's going to be moderately priced. If you're buying a call option that has 6 to 8 months of time, it's going to be more expensive. Volatility has a lot of impact on option prices. Let's say you're in the summer months and you're in a weather market in the grains. They're going to impact the grain markets a lot. It's going to impact your option pricing. Supply and demand for those options also is going to have some impact. You may have some large funds coming in big blocks buying options, and that can help drive prices also. Interest rates that used to impact prices in this zero interest rate environment, it really is not a big factor right now. If you have any questions on this, feel free to call me here at 866-973-2079.